Hi, my name is Lucky Murugesh and welcome to the Lucky Finance channel. I've had a number of people requesting me to look at the finance and bank stocks. So I thought I'll make this video specifically on finance and bank stocks. So the stocks I'm specifically going to be looking at are JP Morgan, Bank of America, Goldman Sachs, BlackRock, MetLife, Ally Bank, Prudential Financial, and finally Berkshire Hathaway. Once again, before I forget, if you do like the video, hit the like button and subscribe, and also hit the bell icon so you can stay ahead of the videos. Thank you. Just the disclaimer, I'm not a financial advisor. All the information you see in this video is purely for informational purposes only. Please consult with your own broker or financial advisor, and remember that investing in stocks is risky, and so you really need to understand fully what you're getting involved with. My job here is to give you information and for you to combine that information with your own research and gain knowledge, and then use your own experience and convert that to wisdom. So as you've seen in some of my earlier videos, this is a simple 6-step process. So in step 1, we review the earnings and the dividends for the current year. In step 2, we review the estimated 5-year growth rate. Step 3, we look at the PE and the PEG ratios. In step 4, we then use that information to calculate the earnings and dividends in 5 years. And finally, in step 5, we estimate the future stock price in 5 years. And then in step 6, I help you set your target buy price based on some assumptions. So let me take you through each of these steps in detail. So for the current earnings and dividends, this is information available online. I happen to get it from seekingalpha.com or TD Ameritrade. You can see the numbers here: earnings per share, JP Morgan $5.11, dividends per share $3.60. That is 2020 earnings per share and dividend per share. What stands out here is Berkshire Hathaway, which is really seen as more of a growth stock, does not pay any dividend. It's zero, but the earnings per share is pretty strong, $9.64. The other thing that stands out to me is how strong the earnings and the dividends are for BlackRock, $27 in earnings and over $14 in dividends. The step 2 is to calculate the 5-year earnings and dividend growth rate, and for this, again, a great site is finviz.com or also seekingalpha.com, specifically for the dividend growth rate. And one thing that stands out here is this really high dividend growth rate in 2020 for Bank of America. This seems unusually high. And it's probably a function of the fact that the earnings growth rate is pretty low, around 5%. The other thing that's interesting is the earnings growth rate over the next 5 years of Berkshire Hathaway, which is 23.3%. I think the other thing that's really pushing the dividends per share for Bank of America is the fact that the company is expected to make a lot of money with rising interest rates over the next few years, and they will pass some of that back to the stockholders. For Ally Bank, I estimated a dividend growth rate of just 15, because that's something that's hard to find on the internet. I think that would be a reasonable assumption. The other thing that was surprising is how low the earnings growth rate is for MetLife, only 1.6%. That seems really low. If you look at the forward PE and the PEG ratios in step 3, I've put the numbers down here. Nothing really stands out on the PE ratios. On the PEG ratios, I think JP Morgan seems to have an unusually low PEG ratio, and BlackRock has somewhat of a higher PEG ratio. I've assigned some fair value PEG ratios here. You can see for the banks typically around 0.8, for the growth company Berkshire Hathaway about 1.2, for some of the private equity investments and financials around 0.8, and then for the insurance companies about 0.7. And this is pretty much in line with historical numbers for PEG ratios. So now we look at the earnings and dividends in 5 years, and we calculate that. We take the 2020 earnings, we multiply that by 1 plus the earnings growth rate divided by 100 raised to the power 5, because we're looking at this 5 years from now. Same thing for the dividends. We take the 2020 dividends, we multiply by 1 plus the dividend growth rate divided by 100 raised to the power 5 again. So if you do that, you can see the total earnings, dividends. So basically, JP Morgan 5 years from now is expected to return $14.13 per share in earnings and dividends combined. And if you do the same across the board, you'll see BlackRock is humongous, almost over $55, $56 per share. I just want to remind you, if you like this video, please hit the like button and also subscribe. And don't forget to hit the bell icon so you can stay ahead of all my new videos. I typically post a video at least 1 or 2 every week. Thank you. All right, it's time to calculate the 5-year stock estimator. So what you do is you take the earnings and in 5 years and the dividends in 5 years, and you add them up. You multiply by the PE ratio and the fair value PEG ratio that I showed you earlier. And if you do that, you can see for JP Morgan, you get a 5-year stock price of $131. The stock price today is around $100. What this means is if you bought today at $100 and the stock went to $131 5 years from now, essentially you would have gained 31% over the next 5 years. Or if you just average that out on an annual basis, you would have made 6%. That's not so great. So that's kind of low. If you do the same thing for Bank of America, the stock price in 5 years is estimated to be about $53. Remember, that was driven by the high dividend growth rate. And the current stock price is 25. So over 5 years, they're expected to make over 100% return, or around 23% annually. And you can see some of the stocks like Ally Bank actually are going to lose money. You'll make a negative 7% per year, or a negative 33% over the next 5 years. That, at least on my calculation. Berkshire Hathaway, very strong. At current prices, you're expected to make 208% or 42% a year over the next 5 years. Goldman Sachs, somewhat weak. I think the stock price is a little too high. BlackRock, reasonable, 83% in 5 years or 17% a year. Prudential, somewhat weak. And you can see MetLife, you actually lose money and you don't gain anything over the next 5 years. So interesting mix of returns over the next 5 years just in these 8 stocks. So now, how do you set your target buy price? So if you look at these stocks, only about 4 of them look attractive. Actually, Berkshire Hathaway, Bank of America, and BlackRock. Just those 3 actually, not even 4. If you want to make a 15% return or better, here are the prices I would recommend. I would recommend you buy JP Morgan around $75 a share. It's at 100 right now, so it has to go down at least 25%. Would that happen? It could happen. I think it went down as low as around $80 in March. And I think there is a possibility it could get down to that level again in the next couple of months. Bank of America, $30, and it's already at 25. I think this could go back to the $20, $21 range, and that would be a better price. I would avoid Ally Bank. I think Berkshire Hathaway looks very strong. I think at 180, it's a good buy right now. It could go a little lower, maybe mid 165 to 170 range, but it's still a pretty good buy. I think Goldman Sachs, you wait till it goes down to the 139, 140 range, which is where it was actually in March. That would be a much better price. And I think BlackRock actually could go all the way down to maybe the low 400s. It's at 541 right now. I believe it went all the way down to the mid 300s in March. I'm not sure it's going to go down that much if the stock market does go down, but it could be maybe around 430, 440. I think Prudential, you wait till it gets down to about $49, $50. And MetLife, I wouldn't touch until it gets down to the low 20s. Okay. Some of the risks to consider, lots of risks. Banks and financials are strongly tied to the economy and to interest rates. So interest rates are expected to stay low for the next couple of years, but then could rise very sharply with rising inflation. Obviously, why is there inflation? Because the Fed is printing money like there's no end to it. And that's going to hit inflation probably 3 to 4 years from now. And then what could happen is the banks will also see their earnings rise as the interest rates go up in years 3 to 5. The other thing is the insurance companies are going to pay a pretty hefty price with the COVID-19 situation. I think there could be 20 to 25% businesses that go bankrupt that will have insurance claims, and some of these insurance companies are going to have to pay. So that's going to be tough. Also, financials are impacted by the political environment. It is an election year. Typically, a Republican presidency and Senate tends to help banks and financials, while a Democratic presidency could hurt them. But that could change. That's just what it's been. But right now, things are changing so quickly, it could be anything. It's hard to say. So in conclusion, I think banks and financials, they offer an excellent play to make a steady 15% return. But the key is to buy these assets at the right price. I think right now I showed you a few stocks that offer good value. I think if I was you, I would wait for a 15 to 25% pullback in some of these stocks before I invest. I think that wish could be granted in the next few weeks as the full impact of COVID-19 hits the numbers on Wall Street, and I think people start to factor in that into the new norm. So wait for a 15 to 20, maybe 25% even pullback. Thank you very much for your time. Again, as always, if you like the video, hit the like button. Please subscribe and hit the bell icon. Thanks so much. Bye-bye.